This is the Alhambra Investments Review and Outlook. Fed Chairman Jerome Powell delivered his semi-annual testimony to Congress this week. No big surprises and not much reaction from the market. Powell stressed the need for patience with regard to interest rate changes, and he indicated the Fed would be rolling out a plan to end its balance sheet contraction. It's interesting that in 2 days of testimony, not one member of the House Financial Services Committee asked a single question about interest rates or monetary policy. U.S. economic growth cooled a bit in the fourth quarter, but at 2.6%, it was much better than expected. Year over year, fourth quarter to fourth quarter, GDP rose 3.1%. This is a first estimate because of the government shutdown, and there's considerable doubt about its accuracy. In particular, consumption was reported up 2.8%, which is hard to reconcile with the slowdown in retail sales in December. But confirmation is coming in from other reports, including inventories, personal consumption, and the savings rate. Even if fourth quarter growth is downgraded, it doesn't change the big picture, which is a slowing economy growing near the long-term trend of 2%. Housing starts in December also confirmed the slowdown, falling 11.7% to a seasonally adjusted rate of 1.078 million. That's well below expectations of 1.214 million and continues a falling trend that started last spring. The level of starts today is about the same as 2013 and consistent with recession levels of starts in the last business cycle. Americans saved more in December. Personal income rose by 1%, while consumption fell 0.5%. That pushed the savings rate up to 7.6%. The savings rate has been in a general uptrend since hitting a low of 2.2% in 2005. A high savings rate is a long-term positive when savings are converted to investment and eventually higher productivity. But it can also be a negative for growth in the short term. Higher saving in December may have been due to concerns about the financial markets or maybe indirectly the government shutdown. Consumer confidence has been falling since December, but had a healthy rebound in February. The Conference Board's index rebounded 10 points, with expectations leading the recovery. The Chicago Fed National Activity Index, one of our favorite broad indicators, fell to a minus 0.43 in January, confirming the slowdown that we've been reporting. The one-month drop means that growth in January was below trend, and isn't that unusual? The three-month average is down to positive 0.16, well above the negative 0.75 that we use as a recession warning. Boil it all down, and it means growth is falling back to trend of 2 to 2.5%. Commodities finally took a breather this week, with both the major commodity indices down. The Bloomberg index fell 1.41%, while the GSCI dropped 1.84. Gold was also down on the week, down 2.52%. There were some exceptions to the selling as palladium continued to surge, joined by platinum and copper. Crude oil was down for the week. Looking at stocks, Eurozone stocks were up nearly 2% on the week in spite of continued weak economic data. Foreign stocks generally outperformed their U.S. counterparts this week, but emerging markets were lower. EM stocks have become very popular in recent months, and we're considering reducing our exposure. To see an interview with Alhambra CEO Joe Calhoun about our current asset allocation, go to alhambrainvestments.com. In the U.S. market, growth stocks took the lead, up 1.02%, while value stocks were off by 0.14. Bonds were also lower, with the 10-year Treasury yield ticking up to 2.74%. Chairman Powell's testimony this week was, by most accounts, pretty boring. He didn't say anything to upset the market. His observations about the economy were very conventional, and his comments on the balance sheet were seemingly designed to soothe market worries about the impact of quantitative tightening. In short, Mr. Powell may not have capitulated to the president, but the stock market seems to be a different story. Falling stocks are a threat to the economic expansion. Just look at the retail sales and housing numbers from December. We don't know if the retail numbers are correct, but it would be a mistake to dismiss them. There have been several other reports that support the slowdown narrative. Inventories rose in December, just as you'd expect with a sales slowdown. And the personal income and spending report from December confirms the retail sales report. We don't believe the fall in consumption and the drop in the stock market are coincidence. Ben Bernanke's Federal Reserve used quantitative easing to create economic activity. It was mostly psychological. And because investors thought QE would push stocks higher, they created a self-fulfilling prophecy. But psychology works in both directions. If the public now believes that QT will pull down stocks and growth, then that's exactly what will happen. The slowdown in economic activity in December seems to confirm that. We're still thinking through the long-term implications of all this, but our instinct says it's inflationary. And if democratic socialists such as AOC get their way with modern monetary theory, which is barely a theory and certainly not modern, watch out. No one today seems to remember how painful it was trying to beat inflation in the 70s and 80s. We may be about to learn that lesson again. Now, here are the week's closing numbers.